This is a price quote. Two numbers on two screens, supposedly representing the same metal. The COMEX silver futures contract, the benchmark that determines what Americans pay for silver, what ETFs value their holdings against, what the financial media reports, closed yesterday at $76.14 per ounce. At the exact same moment, the Shanghai Gold Exchange's silver contract, the benchmark for the largest silver-consuming nation on Earth, closed at 6,847 yuan per kilogram. Convert the units, convert the currency. The Shanghai price translates to $94.23 per ounce. $94.23 versus $76.14. An $18 gap. A 24% premium for silver in Shanghai over silver in New York. This is not supposed to happen. The global silver market is supposed to be integrated. Arbitrage is supposed to keep prices aligned across continents. When Shanghai trades higher than New York, traders buy COMEX contracts, take delivery, ship the metal to China, and sell at the higher price. The arbitrage closes the gap. The markets reconverge. That's how commodity markets have worked for 100 years. The gap isn't closing, it's widening. Last month, the Shanghai premium averaged $8. 2 months ago, it averaged $4. The premium has been growing steadily for 6 months, and the acceleration in the past 30 days suggests something has fundamentally changed in how silver flows between East and West. The great decoupling has begun. The unified global silver market that existed for decades is fracturing into regional markets with regional prices. And the implications extend far beyond precious metals, to currencies, to trade, to the architecture of the global financial system itself. Here's what they're not telling you. The Shanghai COMEX premium isn't just a trading opportunity. It's a signal that physical silver is no longer flowing from west to east through normal market channels. For 20 years, the silver trade followed a predictable pattern. Western mines produced metal. Western refiners processed it. The metal flowed to exchanges in New York and London, establishing the global benchmark price. Asian buyers, Chinese manufacturers, Indian consumers, Japanese electronics companies, purchased silver at the Western benchmark plus shipping and import costs. The premium for Asian delivery was typically 50 cents to $1.50 per ounce, reflecting logistics rather than scarcity. That pattern has reversed. The premium for Asian delivery is now $18, far more than shipping costs, far more than import duties, far more than any logistical friction can explain. The premium exists because silver isn't arriving in Shanghai in the quantities Chinese buyers need. At 9:15 a.m. Beijing time on Thursday, the Shanghai Gold Exchange published its weekly inventory report. Silver stocks held in SGE-approved vaults totaled 2,847 metric tons, down from 4,212 tons at the same time last year. A 32% decline in exchange inventory while Chinese silver demand grew 18%. The math doesn't work. Chinese industrial demand, solar panels, electronics, EVs, medical devices, requires approximately 7,500 tons of silver annually. Chinese mine production supplies 3,200 tons. The difference, 4,300 tons, must come from imports. Those imports must come from somewhere, and the Western exchanges that historically supplied them are running low themselves. COMEX registered inventory stands at 31 million ounces. LBMA vault holdings, as last reported, totaled approximately 850 million ounces, but that number includes metal already committed to ETFs, industrial users, and other claimants. The freely available supply in Western vaults is a fraction of the headline number. When two markets both need metal that doesn't exist in sufficient quantities, price divergence is the result. Shanghai bids up to attract supply. New York bids less aggressively because American industrial demand for silver is lower than Chinese demand. The premium emerges as the market's mechanism for directing scarce metal to the buyer who needs it most. China needs it most. And China is willing to pay $94 to get it. This is where the lie becomes unsustainable. To understand why the decoupling is permanent rather than temporary, you need to understand how the arbitrage mechanism has been deliberately broken. The trade that should close the gap works like this. An arbitrageur buys a COMEX futures contract at $76. They stand for delivery, receiving 5,000 ounces of silver in a New York or Delaware vault. They arrange shipping to Shanghai. They sell on the SGE at $94. They pocket $18 per ounce minus costs. At 5,000 ounces, that's $90,000 profit per contract, minus perhaps $15,000 in logistics. A $75,000 profit for a trade that takes 4 to 6 weeks. The profit is obvious. The trade should be crowded. Arbitrageurs should be draining COMEX inventory to ship east, and the resulting supply in Shanghai should compress the premium. It's not happening. The trade is being blocked, not by regulation, but by physical constraints that make execution impossible. COMEX delivery times have extended from 2 business days to 3 to 4 weeks. The metal that's supposed to be available for immediate delivery isn't immediately available. Traders standing for delivery report repeated delays, partial fills, and pressure to accept cash settlement instead of physical metal. The exchange isn't refusing delivery, that would be a default, but it's making delivery difficult enough that many traders accept cash rather than wait. Shipping logistics have deteriorated. Container rates from Los Angeles to Shanghai have tripled since 2023. Shipping insurance for precious metals cargo has increased 400% due to Red Sea disruptions and general supply chain stress. The logistics cost that used to be $2 to $3 per ounce is now $6 to $8 per ounce, eating into the arbitrage profit. Chinese import procedures have tightened. The People's Bank of China now requires approval for silver imports exceeding 10 metric tons, approval that takes 2 to 3 weeks and isn't guaranteed. The ostensible reason is anti-money laundering compliance. The practical effect is that large arbitrage shipments face bureaucratic delays that make the trade timing uncertain. Each friction, delivery delays, shipping costs, import procedures, individually wouldn't break the arbitrage. Together, they create enough uncertainty that the $18 premium persists. The premium is the market's measure of how broken the arbitrage mechanism has become. At 6:30 a.m. Eastern on Friday, a Hong Kong-based trading firm published an analysis showing that the effective arbitrage cost between COMEX and Shanghai now exceeds $14 per ounce, up from $2.50 2 years ago. At $14 in costs, an $18 premium yields only $4 per ounce in profit, not enough to compensate for the risk and capital commitment required. The arbitrage that should close the gap no longer makes economic sense. When arbitrage breaks, prices can diverge indefinitely. Markets stay disconnected because the mechanism that connects them no longer functions. When prices diverge between East and West, the question becomes which price is real. The COMEX price is the benchmark that Western finance uses. It's the price in your brokerage account, the price that SLV references, the price that mining companies report revenue against. It's the price that matters for anyone operating in dollar-denominated markets. The Shanghai price is the benchmark for physical consumption. It's the price that solar panel manufacturers pay, that electronics assemblers budget for, that industrial users actually transact at. It's the price that matters for anyone who needs silver to make things. The financial price is $76. The industrial price is $94. For 30 years, these were the same price. Now they're not. The divergence creates a two-tier market. Western investors holding paper silver, ETFs, futures, unallocated accounts, own exposure to the $76 price. Chinese manufacturers buying physical silver pay the $94 price. The Western investors' silver is worth $76 on their statement, but if they wanted to sell that silver to a Chinese manufacturer, the transaction would happen at something much closer to $94. The paper price understates what physical silver is worth to people who actually use it. The gap, $18 or 24%, is the discount that Western paper holders accept versus Eastern physical holders. Less than 45 days remain before a scheduled meeting of the Shanghai Cooperation Organization, where currency and commodity settlement alternatives will be discussed. Intelligence suggests that silver and gold pricing mechanisms will be on the agenda, with China proposing that SCO members use Shanghai benchmarks rather than COMEX or LBMA prices for trade settlement. If adopted, the proposal would formalize the decoupling. SCO members, China, Russia, India, Pakistan, Iran, and the Central Asian states, represent 3.4 billion people and 40% of global silver demand. If their trade settles against Shanghai prices rather than COMEX prices, the $94 benchmark becomes the reference for the largest consuming bloc on Earth. The COMEX price becomes a regional benchmark, relevant for North American and European markets, but not for the majority of global physical demand. The $76 price becomes what Americans pay. The $94 price becomes what everyone else pays. While one market stagnates, the other market builds. China isn't passively accepting the supply shortage. They're restructuring the global silver supply chain to serve Chinese needs first. At 2:30 p.m. Beijing time on Wednesday, the Chinese Ministry of Commerce announced strategic partnership agreements with silver-producing nations in Latin America. The agreements reportedly include financing for mine development in exchange for guaranteed offtake at Shanghai-linked prices. Peru, Mexico, Chile, and Argentina, collectively producing 45% of global mined silver, are negotiating terms. The structure is familiar. China has used similar agreements to secure copper, lithium, and cobalt supply throughout Africa and Latin America. They provide development financing that Western institutions won't offer. In exchange, they get first rights to production at prices linked to Chinese benchmarks. The producing nations get investment. China gets supply security. If Chinese-financed mines sell silver at Shanghai prices rather than COMEX prices, the supply that historically flowed to Western exchanges will be redirected to Chinese refiners. The decoupling accelerates. The Western inventory shortage deepens. The premium widens further. At 11:45 p.m. Eastern on Thursday, satellite imagery analysis published by a defense intelligence contractor showed construction activity at 3 sites in western China, consistent with new silver refining capacity. The facilities, if completed, would add approximately 15,000 metric tons of annual refining capacity, roughly 20% of current global capacity. China is building the infrastructure to process silver domestically at scale. They're securing supply agreements to feed that infrastructure. They're pricing the output against Shanghai benchmarks. They're constructing a parallel silver market that doesn't depend on Western exchanges or Western prices. This is what a commodity market bifurcation looks like in real time. Not announced, not negotiated, just built, piece by piece, until the parallel system is large enough to operate independently. This is what the end of unified commodity markets looks like. For 50 years, global commodity prices were set in dollars, on Western exchanges, with Western financial institutions providing liquidity. Oil traded on NYMEX and ICE. Gold traded on COMEX and LBMA. Silver followed the same pattern. The dollar-denominated benchmark was the global benchmark. Alternative pricing didn't exist at scale. That system is fracturing. Russia sells oil at prices disconnected from Brent. China imports commodities under bilateral agreements that reference yuan-denominated benchmarks. India pays for Russian crude in rupees. The unified global pricing system is becoming a patchwork of regional systems with regional prices. Silver is joining the fracture. The $18 premium between Shanghai and COMEX is the spread between the old system and the new system. The spread may narrow temporarily, but the structural forces, supply shortages, broken arbitrage, Chinese infrastructure investment, suggest it will widen over time. Some will look at the Shanghai premium and see a trading opportunity. Will assume the gap will close. Will position for convergence that the arbitrage mechanism is supposed to deliver. These are the same voices that expected the Russia-Europe gas market to normalize after sanctions, that expected the China-US tech supply chain to reintegrate after restrictions, that assume broken markets repair themselves because markets are supposed to be efficient. Sometimes broken markets stay broken. Sometimes the break is the beginning of a new system, not a temporary disruption. Others will recognize what the $18 premium actually represents. The failure of the arbitrage mechanism that kept global silver prices unified. The emergence of a Chinese pricing system operating independently of Western benchmarks. The beginning of a bifurcated market where the price of silver depends on where you're standing and what currency you're holding. The informed are not betting on convergence or divergence. They're recognizing that the unified global silver market they grew up with may no longer exist. That $76 and $94 can both be correct prices for different participants in different markets. That holding dollar-denominated paper silver exposes them to the lower price, while physical silver increasingly trades at the higher one. This is not financial advice. This is not a recommendation to arbitrage the Shanghai COMEX spread or convert paper to physical or take any position based on price divergence. Markets can stay irrational or bifurcated longer than analysis suggests, but consider what the $18 gap is telling you. Silver in Shanghai, where it's consumed, where it's needed, where industrial demand is growing 18% annually, trades at $94. Silver in New York, where it's financialized, where it's traded by speculators, where inventory is draining, trades at $76. One of these markets is pricing silver for what it is, an industrial metal in structural shortage. The other market is pricing silver for what it was, a paper asset in a balanced market. $94 reflects reality, $76 reflects history. The great decoupling has begun. The unified market is fracturing. The benchmark that determines silver's price for 50 years is becoming one of several benchmarks, and possibly not the most important one. Shanghai says $94. COMEX says $76. The gap is $18 today. It may be $25 next month. It may be $40 by year end. Or the markets may reconverge, with COMEX rising to meet Shanghai rather than Shanghai falling to meet COMEX. Either way, the $76 on your screen is no longer the whole story. The whole story is $94 in Shanghai. And that's the price the world's largest consumer is willing to pay for silver that actually exists.